right now, folks, as we do each and every Monday at 3:15 p.m. Eastern Time, we're going to jump over to our man Steve Rhodes. Folks, you can check out Steve's outstanding newsletter, Mastering Probability, right under the newsletter tab at TFNN.com. Remember, every newsletter we have, folks, you get a 30-day money-back guarantee. You can always check out those Tiger Dollars to add savings to Steve's outstanding newsletter. You get all the archive webinars he's done in there as well. You get some time over the holidays. You want to sign up for the letter. You gain access to all the archive webinars. You still get that 30-day money-back guarantee. Check it out. Steve Rhodes, good afternoon.
Hey, Tommy, how are you? Merry Christmas to you.
Merry Christmas, man. We're here. We got these 2 weeks. Kind of cool, man. Falls on a Thursday, right? Feels like we almost get 3-4 day weekends, man. Who's working the Friday after? I don't think TFNN is going to be open, man. That day is a very vacation day. Happy holidays to you and your family as well, Steve. How's it going, man?
Thank you. Well, we got Chamber of Commerce weather that's going to be down here. I'm looking at my phone right now. It's going to be in the mid-70s. That's the way I like to celebrate Christmas.
If only Florida weather was like it was all December, all year round, right? Because, we got some beautiful weather right now. I agree. Especially the mornings, folks, the nights, right? That cool, crisp air, Steve, just beautiful, man. Enjoying it. Great holidays for sure. Absolutely, so how about this market? We're going we're going higher. As that's been the trend this year, Steve. The Santa rally, it's coming, it looks like, right now at least. What do you think?
No, I think you're dead on, and we can use some indicators. So, instead of us trying to have some kind of assumptions, we've got some data that we can use. We've got historical information that provides us with a competitive advantage. And I think a competitive advantage is a good thing to have, especially when you're trading these markets. And one of those competitive advantage tools, Tommy, is the spot VIX index. A lot of people talk about it as a fear gauge or what have you. I have no idea how you would possibly trade that. We don't have to worry about that. I've got technical patterns out here that show us exactly how to trade it. So those folks that are longtime listeners of the Trader's Edge show, they knew on Friday when the spot VIX index closed below minus 10%, that we had a one-day rate of change below that level, and those are the green arrows that are on this screen here. More times than not, when that occurs, we get an initiation to higher price. In fact, when you take a look at all those green arrows on this chart, folks should be taking snapshots of this screen, whether on YouTube TV or inside our Tiger's Den, so they can go back and they can take a look, so they can put this chart together for themselves. We typically go to new highs. So what you just said is spot on, and we can use the spot VIX index as one of those tools that have given us that signal. Now there's more, but there's more information that we can gather from the spot VIX index. For example, I talked about trading sessions that have a one-day rate of change below minus 10%. We also use those one-day rate of changes above plus 10%, and those are the blue arrows that are on there. Those are usually the hard down days inside the market. But it turns out when we get rates of change above plus 10%, we typically get a bounce or a bottom during the next trading session. So especially for intraday traders out there, that's really important, because a lot of times you can catch quite a nice move overnight in the early morning hours out there. So that's another way to use the spot VIX index. There's a third way, which is we can take a look at the spot VIX index versus its futures contracts, its forward future contracts. We can go out 12 months for that. There's another way of doing that, which is taking a look at, I can take a look at the 3, the 6 month, and the 1 year. On the bottom of this chart here, I've got a 3-month counterpart of the VIX, and I compare that to the actual spot VIX. And when we're looking at the very bottom panel, you can see the mathematical formulas here. I'm just simply dividing the VIX by the 3-month counterpart. When that goes above 0, when it goes above 1, we are in contango. And when we are in contango, what it does, provides us with an excellent opportunity of a bottom that's forming. I've just thrown a few of those yellow arrows out there so that you can see, and this is really great for longer term patterns. Now, you can see if we come forward here, most recently, the most recent bottom that we had was one of those signals out there. So that too suggests that we should rally into the end of the year, that we should move higher out there. And then, of course, we have the following element with regard to the spot VIX, Tommy, and that is, how is it trading in regard to its 50-day exponential moving average out there? And that's actually panel number 2 from the bottom. And I'm sorry, panel number 3 from the bottom. And when the spot VIX is below the 50-day exponential moving average, it is buyers that have an edge. And when it's above the 50-day, it is sellers that have an edge out there. So the spot VIX index, a very cool tool. We should never really think about it as a fear gauge, because there's no way to trade that. But I've now just given basically 4 technical patterns that everyone out there can use to help interpret the message of the markets for the S&P 500. I think that's pretty cool.
I think it's amazing, man. Folks, for that chart alone, you got to go check out Mastering Probability because so cool. And if you're in the market enough, Steve, you know that just the VIX matters, right? But to see it on that chart, man, and I was thinking of you Friday afternoon. I was doing the show, and I had the VIX up, and just looking at the numbers, it was like 10.6 or something down. And I said, I remember that, man. And sure enough, now it's down again. I was already, it was remarkable that we hit 15 because we were at 18 on Wednesday afternoon, folks. So Friday afternoon, we're at 15, right? And it's like, oh, okay. That's I see what's happening. Now we're at 14, which is pretty remarkable. Yeah.
Yeah, and what's nice is just it's a straight objective tool. Look, it doesn't mean that it's always going to work out the way that we think, but what we're doing here is we're giving ourselves again that competitive advantage, which I believe is really a great thing to have. Another one of those competitive advantages that we take a look at are the TAS market profiles. They help assist us with regard to where price is headed to. We use the oscillator and change line. This here happens to be a chart where we can take a look at the daily charts for instruments that represent the S&P 500. So one is the actual S&P 500. The other would be the futures contract. Next to that would be the SPY index ETF, and then we've got the equal-weighted ETF. We like to take a look at all four of these charts to see if they are giving us the same message. And it turns out, in the case of the S&P 500, where you trade above a green oscillator and change line, that tells us we have a rising price oscillator above zero. Those are bullish conditions. No reason for it not to continue to move higher with its all-time highs or its T9 count being the target. Inside the ES Mini, if we close the day above the top of its profile, shoot, I didn't have it down here. It's right around the 69.25 level. We would be in very bullish conditions. That would suggest continue to move higher. The SPY is telling us that we should go target 686. And the equal-weighted ETF, which is really important, it's trading inside a bullish structured daily profile. If we get it close today above 192.95, and I know we're trading above that, we should head up to 194.97. So exactly how you just opened up the show, we've got a bunch of tools here that are also suggesting that we should continue to move higher. I don't want to run out of time here, so what I'm going to do is going to just move forward. Take a look at the seasonal patterns. This is a 97-year seasonal pattern. That suggests we should rally up. The red vertical line is going to be where we're at today. Suggests that we should rally up into the end of the year. This is a 97-year post-election cycle, so there's 25 data points. This suggests that we should rally up into the end of the year. Here's a 10-year cycle, Tommy. If we just simply take every year that ends in a 5, I can go back and get the last 10 decades of that. You can see here, we should rally into the end of the year. If I take a look at all bullish years and all those ones with check marks, they are to the left of the year. Each of those were bullish years in the markets. We can see here, we should rally up into the end of the year. The last decade, if we just take a look at the last 10 years, that suggests that we really should rally into about the December 27th-ish type time frame. So the end of this week, maybe the beginning of next week, and then we start to pull back there. So everything, like you just said, is really pointing to a further rally. And if you want to talk about, just finish this here with gold. Gold's made new all-time highs today in terms of dollars, euros, yen, Great British pound, and Swiss francs. The gold does have further to go to the upside. Absolutely.
Yeah. How about that gold, right? I mean, globally. Just versus last week, as I was saying, man, the dollar was weaker than it is like a week ago. It hit a 97 handle. So it's not all about the dollar, man. That is remarkable. Steve, great work. You always do such a great education, putting that work into that. I love statistics and probabilities, man. And that was a great wrap up. Listen, have a great Christmas with your family, man. Thanks for everything you do. We look forward to the program tomorrow, Steve.
You bet. Take care.
Thanks.